Hello, hello, hello. This is June Collier and welcome to my channel. And in this video, I'm going to show you how you can get free cell phone service for the rest of your life. That's right. How would you like if you did not have to pay for a cell phone bill ever again? And it doesn't matter if you're with AT&T, Verizon, T-Mobile, or Sprint, or any other provider. You get free cell phone service for the rest of your life. So if you like to see that, let me show you how it's done. Okay, so now that I have your attention, let me be totally transparent with you. That title is a little bit of a clickbait type of title, but I promise that I'm going to show you how you can get another company to pay for your cell phone bill. Now, I did some research, and the U.S. Bureau of Labor and Statistics say that the average cell phone bill is $114 per month. Wow, that's pretty expensive. And when you look at that over an annual basis, that's $1,368 per person. Now, as you know, my channel is all about stocks. And today I'm going to talk about a cell phone company that pays big dividends for people who own shares of their stock. This company is AT&T. Now, at the time of this recording, AT&T currently pays a dividend yield of 5.41%. The annualized payout is $2.08, which when paid quarterly is 52 cents per share. The stock is currently trading at $38.27. Now, I could sit here and easily tell you to go out and buy 658 shares of AT&T stock, which would cost you, let's see, 658 shares times $38.27 would cost you $25,181.66. And with that, you would earn $1,368.64 per year in dividend payouts. The way that we came up with that is we take those 658 shares, multiply it times the dividend payout of $2.08, and that will give you $1,368.64. That's enough to cover your cell phone payment for the year. Now, if I told you to do all of this, it would be a true statement, and that would be the end of this video. However, most people do not have $25,000 sitting around waiting to be invested. Now, a 5.41% dividend yield is great, but you would still need 18 years of receiving the $13,068 to equal the amount that you laid down initially. Now, that's still not bad because 18 years later, you would still own the stock, and I would safely bet that the AT&T stock would be worth more than it was when you bought it initially. And the dividend payout will have likely increased over the years as well. But listen, I've got something better in mind. What if you could achieve the same results with fewer shares, meaning you didn't have to spend the $25,000? What if instead of a 5.41% yield, you got somewhere between 14% to 23%. Do I have your attention yet? You see, what I'm talking about is the combination of receiving the dividend payouts while also writing something called covered calls on the AT&T stock. If you wrote monthly covered calls every month on your AT&T stock, I would estimate that you could get a 1.5% monthly return. Now, if you annualize this, it would be an additional 18%. If you only wrote covered calls for 6 months out of the year, you would still annualize at an additional 9%. So let's talk about what is a covered call. A covered call is a conservative but effective option strategy when used correctly. It can lower your portfolio risk and improve your returns. As the owner of the stock, you can write a contract giving the buyer the legal right, but not the obligation, to buy 100 shares of your stock at a predetermined price. This is called the strike price. And they can buy this price anytime on or before the expiration date that you set. In exchange for the right to do this, the buyer pays you, the seller, cash, known as premium. Since we're already here at Yahoo Finance, let's take a look at the options chain for AT&T. And so when we go over here and click on the options link, we're going to be brought to something known as the options chain. So this is the options chain, tells us what the price of the options are. And what we're going to do is we're going to go approximately 30 days out, because we're going to be writing options or covered calls on this stock every 30 days. So we're going to go out to March 13th. That's approximately 30 days out. And when we look at March 13th and we go and look at the 38.50. So on March 13th, the 38.50 is currently selling. We're going to expect to receive about 66 cents. So we see that the last price it sold for $70 cents. The ask is 68, the bid is 66. And so when you're selling, you're going to get the bid. So the bid is about 66 cents. So let's look at what that is going to give us percentage wise. So if we go to our percentage calculator here and type in 66 cents and we bought the stock for 38.27, if we click calculate, that's going to give us a 1.7% return. Okay, so remember I talked about a 1.5% return, but in this case it's going to give us a 1.7% return if we sell the covered call for the 38.50. Now remember, if we get called out, we actually bought the stock for 38.27. So if we get called out, we're going to pick up an additional an additional 23 cents on this particular stock if we get called out. So here's what we mean by getting called out. So I'm giving the person who is buying the covered call from me, I'm giving them the right to buy this stock at 38.50. I purchased the stock for 38.27. That means that if they buy it from me for 38.50, I picked up an additional 23 cents. How did I come up with that? Let's go ahead and pull out our calculator. If I sell it for 38.50 and I paid 38.27, I receive an additional 23 cents. So what I have to do is I have to add the 23 cents to the 66 cents that I got just for selling the contract. So I got 66 cents for selling the contract, but if the contract got called out, I pick up another 23 cents. So if we go back here to the percentage calculator and add the 23 cents here, the 23 cents would be 89 cents. So I would pick up a return of 2.3% on my stock. So see, whether or not I get called out, I'm not concerned with that. If I get called out, that means that my percentage is a little bit higher, and then I turn around and I buy the stock right back again, okay? So again, if I sell this for 66 cents, I'm going to pick up, for every 100 shares that I have, I'm going to pick up $66. They're going to pay me $66 for every 100 shares that I have. Now, we can repeat this process each and every month, picking up the covered call premiums, as well as pick up the dividends, just as long as we're holding the stock by X dividend date. So I went back here to the summary report. You'll see where it says X dividend date. To get the dividend payout, you would have to have had the stock prior to January 9th. So you need to make sure on January 8th you got the stock, and then they're going to pay you the dividend as long as you hold the stock prior to the X dividend date. So you got to have it by this particular date. But we can write this and pick up the dividends every quarter, and then every month we can write the covered calls on this particular stock. Now, this strategy gives us double rewards, and the income generated from this strategy allows us to be able to purchase less shares of AT&T. So instead of having to pay the 600, I forget what it was. I think I said it was 658 shares. Instead of paying 658, buying 658 shares of stock, we can buy somewhere between 200 to 300 shares of stock. So if we bought 200 shares of stock times the 3827, we would only have to put out $7,654 to be able to essentially do the same thing. So we would be able to pick up on the dividends as well as pick up on the premiums from writing the covered call, and that would allow us to earn enough income to pay for our cell phone bill each and every month without us having to come out of pocket for it outside of our normal paychecks. And so there you have it. This is how you can get free cell phone service for the rest of your life by using the dividend and covered call strategy together. So I hope you guys have enjoyed this video. If you did, please hit the thumbs up button and leave me a nice comment. Now, if you disagree with my methods here and you think that I'm utterly incorrect and I'm off basis, go ahead and give me a thumbs down. And then let me know why you think this is a bad strategy. In any regards, thank you for watching. I do appreciate all of the comments. I appreciate all of my viewers. And if you have any videos that you'd like to see in the future, leave that in the comment section below as well. Hey guys, this is June Collier. Thank you for watching. Have a great day, and we'll see you in the next video.